You know that feeling, right? The more you earn, the more you seem to pay in taxes. It can feel like you're on a treadmill, running faster just to stay in the same place. But what if one of your biggest potential investments could be flipped into your greatest financial tool? Today, let's deconstruct the real estate wealth engine.
For so many high earners, it's this frustrating cycle. You get a raise, you work harder, and a bigger chunk just goes right out the door to taxes. It's a serious drag on creating real, lasting wealth. But what if a rental property could do way more than just bring in a little extra income every month?
So you've probably heard the standard advice, and it's always broken into two separate buckets. First, they say, go buy rental properties for that passive income stream. And second, make sure you set up an LLC, to shield your personal assets. But here's the thing. That surface level thinking completely misses how these two pieces are meant to plug into each other to create something way more powerful. Let's just look at how most people see this. On one hand, you've got rental properties. Their goal, cash flow. That monthly rent check is what it's all about. Then over here you have the LLC, and its job is basically to be a legal bodyguard, right? A simple shield to protect your personal stuff if a tenant slips and falls. It's a very siloed way of thinking. Okay, this is where we need to completely flip the script. The rent? That's just the beginning. See, the most strategic investors, they know the property itself is the engine. The rent is just the fuel that makes it run. So let's dive into the hidden mechanism they use to seriously accelerate their wealth. All right, the absolute core of this whole strategy comes down to one powerful, but let's be honest, often misunderstood accounting principle. It's fully sanctioned by the tax code, and it's called depreciation. To put it simply, the government knows that buildings don't last forever. They wear out. So the tax code lets you deduct a piece of the property's value every single year as a paper expense. Now here's the magic part. This is a non-cash deduction. You're not actually spending any money, but you still get the tax break. And you can take it even while your property's actual market value is going up. For residential buildings, there's a magic number, 27.5 years. That's the standard time frame over which the value of the structure itself, now not the land, just the building, is depreciated. This very specific number is what sets the size of that annual tax deduction that powers this entire strategy. Okay, now this is where it gets really fun. On this slide, we're looking at two different investors. They buy the exact same $1 million property. They have the same rent coming in, the same mortgage, the same everything. But as you're about to see, their financial outcomes are worlds apart. So let's start with Investor A. They're doing everything by the book, the conventional way. They're focused purely on cash. After all their expenses, they've got a nice $8,000 in positive cash flow, but they're in a 37% tax bracket. So they have to send a check to the government for nearly $3,000, which leaves them with just over $5,000 in their pocket. It's profit, sure, but it's taxed profit. Now check out Investor B. They also have that same $8,000 cash in their bank account. But on their tax return, they do something different. They subtract a depreciation deduction of over $29,000. So that $8,000 cash profit suddenly becomes a $21,000 loss on paper. And the result? The tax they owe on this income is a big, fat zero. And that is the fundamental difference. Investor A is paying into the system. Investor B is using the rules of the system to their advantage. And let's be super clear, this isn't some shady tax evasion. It's about understanding how the tax law is literally designed to encourage people to invest in real estate. So that paper loss we just talked about, it's not just some funny number on a tax form. When you know how to use it, it becomes an incredibly powerful shield that can protect the income from your main job or your primary business. This slide really breaks down the three-step play. First, you use depreciation to generate that paper loss. Second, and this is a big one, you have to actually qualify to use it against your other income. For a lot of people, this means achieving what's called real estate professional status. It's a specific tax designation with some pretty strict rules, like having to spend more than 750 hours a year on real estate activities. Then, step 3. Once you're qualified, you can take that paper loss and apply it directly against your W-2 salary, which can dramatically lower your overall tax bill. So, by connecting all the pieces, you've just transformed your rental property. It's no longer just a little side hustle. It's now a tax shelter for your main source of income. That loss from your real estate directly chips away at the taxable income from your career. Okay, but there's a huge catch. This entire powerful financial engine is incredibly vulnerable if the legal structure around it, your LLC, isn't set up and managed with absolute discipline. That protection you think you have, it's not automatic. To make sure that Liability Shield actually works when you need it, there are some cardinal rules you just can't break. First, you have to form the LLC before you buy the property. You have to use the business's unique ID number, its EIN, for all the accounts. You absolutely need a dedicated business bank account. And the big one, you can never, ever mix your personal and business money. The second you get lazy, you pay for groceries with a business debit card or you deposit a rent check into your personal account, you're basically creating a crack in your armor. If you get sued, a court could look at that and say, hey, there's no real separation here. And just like that, they can pierce the corporate veil. That means your personal home, your car, your savings, everything is suddenly at risk. So you can see the profound shift in thinking here, right? It's all about moving from seeing these as two separate tools, a rental for cash, an LLC for safety, to understanding them as one single integrated system. The LLC protects the asset, and the asset, through the power of depreciation, protects all of your other income. When you boil it all down, the real takeaway is that strategic wealth building isn't just about earning more money. It's about engineering a system that lets you keep more of what you earn. So the question you really have to ask yourself is this: are you just collecting assets, or are you building a true wealth engine?